exercise 2-4. This is on page 102 in your text, and I have it pulled up right here. And we're going to work through some journal entries. So Ned Brown opened a medical practice in San Diego, California, and had the following transactions during the month of January. So on January 1, it says the business received $21,000 cash and gave capital to Brown. So remember, when we're trying to analyze transactions, first thing is to identify what two accounts are being affected. So we know he received cash and then gave capital. So we got cash and capital. And the business received the cash, so cash is going up, and we're giving capital to Brown, so we're increasing our capital account. So cash is an asset, capital is an equity account. So to increase an asset, we have to know what the normal balance is, so it's a debit. And to increase equity, its normal balance is a credit. Okay, so we increase capital with a credit and increase cash with a debit. So we'll come over here and say cash, debit 29,000. All right, and then we'll do Brown capital 29,000. All right, and this will be how we record. And when we record journal entries, we'll typically do like a little note description on what the journal entry is about, why we recorded the journal entry. So we'll put received cash from Brown in exchange for capital. And it has to be really short, just to describe what the transaction was, right? And so remember, this is where we're actually posting the journal entries. Journal entries are recorded in the general journal. Then we'll post these journal entries to the T accounts and then summarize the balance in the T accounts and the trial balance, and use the trial balance to create our financial statements. Okay, so this is just the first part. Then we've got January 2nd, says we purchased medical supplies on account $14,000. So we made a purchase, so we're spending some kind of cash. However, it says we purchased them on account. So when we see on account, remember, anytime we're on account, we've incurred a cost when we're talking about paying something or buying something and we haven't paid it yet. So that's a liability. That's accounts payable. So we've got accounts payable here, and we're purchasing medical supplies. So we're getting the supplies. That's what we're getting. And supplies is an asset. So we've got an asset and a liability. So we increase assets, we're actually getting supplies. So we're going to increase our supplies account 14,000. And since we haven't paid it yet, we're going to have accounts payable, and we're going to credit accounts payable to increase it 14,000. All right. And then our description will be purchased medical supplies on account. All right. Okay, then we'll get to January 4th. It said we performed services for patients receiving $1,400. So again, it says we received $1,400. So that means our cash is going up. So we're going to debit cash, $1,400. And we performed services. So in performance of services, we're going to recognize service revenue of $1,400. All right. And this is, we performed services for patients. So now on January 12th, it said we paid monthly office rent of $2,600. So we're paying something. That means cash is leaving the business. So our cash is going to decrease. And when we decrease cash, we credit cash. So we're going to credit our cash, $2,600. And then we paid rent. If you remember, rent is a cost of doing business. It's helping us generate revenue. So it's an expense. So we're going to identify it as rent expense, $2,600. And so when we increase expenses, that's a debit. Okay, it's expenses under the equity section of our accounting equation, but since it decreases equity, it has the opposite normal balance. So equity items usually increase with a credit, but rent expense and owner withdrawals increase with a debit. Okay. All right. The last one is January 15th. It says recorded $8,000 revenue for services rendered to patients on account. So here's that on account again. We've performed services, okay, and we're recording the revenue, but we rendered it on account. So we already did the service and we haven't gotten paid. So this is what we call accounts receivable. Oh, and I forgot to put the description for that one. So we paid rent with cash. All right. So that's what we call accounts receivable. And we have accounts receivable of $8,000. Even though we haven't received the cash since we've done the service, provided the service, we're going to go ahead and record our service revenue. And this would be, our description would be performed services for patients on account. All right. And that's how we would record the transactions in short exercise 2-4.